Hello, everyone, and welcome back to Collin Investing, where we dive deep into the world of finance and investment. Today, we're tackling a lot from plummeting consumer confidence and stagflation fears to the ripple effects of Trump's tariff threats. We're also going to break down what's happening with key stocks like NVIDIA, Tesla, Hims and Hers, HED and UNH. We've got a jam-packed session, so let's jump right in. So, what's the first major tremor shaking the markets? It's a significant drop in U.S. consumer confidence, and this isn't just a minor blip. We're talking about a substantial decline in February's Consumer Confidence Index, and that sets off alarm bells because, as many of you know, consumer spending is the engine of the U.S. economy. Now, the core issues dragging down this confidence are twofold: persistent, sticky inflation and increasing anxieties around employment. People are feeling the pinch, and they're worried about their job security. But here's where it gets even more interesting or concerning depending on your perspective. Future inflation expectations have actually jumped, surging to 6% from 5.2%. That's a considerable leap, and it's far above the Federal Reserve's 2% target. Now, what does this mean for us? We have to look deeper. It means that consumers expect prices to rise in the future, and that can influence the market. Finally, to add another layer of complexity, we're seeing a noticeable spike in discussions surrounding trade and tariffs. It is clear that former President Trump's trade policies are looming large in the public consciousness and creating economic uncertainty. Building on that point about rising inflation expectations, we have to address the elephant in the room: stagflation. It's a word that sends shivers down the spine of any investor, and for good reason. Now, Wall Street is starting to whisper about its potential return, and we need to understand why. Essentially, despite the Federal Reserve's aggressive interest rate hikes, inflation is proving incredibly stubborn. It's like a weed that keeps popping back up, no matter how many times you try to pull it out. We're still hovering well above that 2% target the Fed has set, and that's fueling these stagflation concerns. Let me tell you a little story of what happened a few decades ago when I was still a young stockbroker. I'd personally witnessed the devastating consequences of it. It's a brutal combination of slow economic growth, high unemployment, and rising prices. Think of it as the perfect economic storm. Historically speaking, stagflation has been a disaster for private investment. Businesses struggle, they are forced to close the doors, and people, unfortunately, lose their jobs. This is not a theoretical abstract problem. It has real-world consequences for families and communities. It's a period where economic growth essentially stalls, which creates uncertainty. So, although recent data showed an increase on future inflation expectations, the question becomes, are these real concerns or just a market overreaction? Now you might be thinking, okay, stagflation sounds scary, but are we actually heading there? And that's the critical question we need to address. While the concerns are valid, it's important to remember that the U.S. economic growth, although slowing, is still in relatively good shape. We're not seeing the kind of collapse that would typically accompany a true stagflationary environment. And perhaps more importantly, overall inflation, while sticky, is still below 3%. That is still far from ideal, but not a disaster. This leads us to a potentially pivotal moment: the upcoming release of PCE data, or personal consumption expenditures. This is the Federal Reserve's preferred inflation gauge, and the market is anticipating, praying, really, that it will show a drop to a 7-month low. If that happens, if we see that PCE number come down significantly, it could be the soothing balm the market needs. It could very well ease those stagflation fears and potentially trigger a rebound. So all eyes will be on that PCE report. It has the potential to shift the entire narrative. But that's not the whole story. Because layered on top of these economic anxieties is the looming specter of a trade war. And this is where former President Trump's tariff threats come into play. He stated his intention to impose tariffs on both Mexico and Canada. And we're not talking about symbolic gestures here. These tariffs could have teeth, with a potentially significant impact on various industries. We're talking about steel, aluminum, automobiles, and a whole host of other sectors. Consider a situation where these tariffs take full effect. This could potentially raise costs for companies and eventually consumers. Now, the potential fallout is particularly concerning for our neighbors to the north. Some economists are predicting, and these are not idle predictions, that a 25% tariff could be enough to push the Canadian economy into a recession. That's a serious economic blow, and it foresaws the interconnectedness of our global economy. Remember that PCE report. It could be very important to alleviate the concerns, but the tariffs could bring additional costs, and it's not just about Canada. U.S. consumers could also feel the pinch. These tariffs, while aimed at protecting American industries, could very well lead to increased costs for everyday goods. It's a complex equation with potential winners and losers on both sides of the border. So, in short, the tariff situation adds another layer of uncertainty and volatility into the market. With that in mind, let's examine the very real-world consequences of these tariff threats. We're seeing a significant shift, a strategic recalibration, as many Canadian companies are seriously considering relocating to the US. And why? Simply to avoid the brunt of these potential tariffs. It's a purely pragmatic bottom-line decision. Think about companies like Schumbeck to Collin Investing, a major e-Hangzhong player, or Lululemon, the athletic apparel giant. These aren't small, niche businesses. A massive portion of their revenue, 66% for Schunhon and 65% for Lululemon, comes from the US market. So, for them, absorbing substantial tariffs is just not a viable option. It is a threat to their survival. They must protect the business. Now, this potential exodus of Canadian businesses highlights the stakes of this trade dispute. We are talking about jobs, investments, and the economic stability of entire industries, and it is not a one-way situation. The Canadian officials, understandably, are not taking this lying down. They're exploring various countermeasures, some of which are quite drastic. We're even hearing whispers of potential water and power restrictions, leveraging Canada's control over crucial resources shared with the US. This particular point carries considerable weight, referencing the Columbia River Treaty in one of the related YouTube videos transcriptions. Imagine that, using waterways and electricity as bargaining chips in a trade war. This speaks to the seriousness of the situation and the lengths to which nations might go to protect their economic interests. It's important to acknowledge the complexities here. So this is a situation with the power to impact the economy, and that's where Tesla comes in. And unfortunately for shareholders, it's not a pretty picture. The electric vehicle giant has taken a beating, with its market value dipping below that symbolic $1 trillion mark. Now one will wonder, why is this happening? Well, there are several factors at play here, and it's a bit of a multi-front battle for Tesla. First, let's look at Europe. Sales over there absolutely plummeted in January. We're talking about a staggering 45% drop. That's a massive decline, and it's particularly concerning because, as a reference, the overall electric vehicle market in Europe actually grew during the same period. So this isn't an industry-wide problem. This is a Tesla-specific problem. Then we have the China situation. It's a huge, crucial market for Tesla, but it's also a battlefield. The competition there is absolutely intense. We're talking about dozens of EV manufacturers, all vying for market share. It's a crowded, cutthroat environment, and this intense competition puts enormous pressure on Tesla's margins and its ability to maintain its dominance. Finally, here's the Elon Musk factor. Now I have to be candid here. There are growing concerns, and I share some of them, about his divided attention. He's the CEO of multiple companies, SpaceX and XAI among others, and that's spreading his focus thin. For Tesla shareholders, this raises a legitimate question. Is the company getting the full attention it deserves from its leader? It's a question that needs to be addressed, and it's certainly contributing to the current market uncertainty surrounding Tesla. Remember that key concept. Tesla's challenges, particularly regarding sales in Europe and competition in China, well, it plays directly into this next point, about its operations specifically in China. While Tesla faces stiff competition and recent sales dips, here is a potentially significant development brewing on the software front. Tesla recently rolled out a software update in China that includes features remarkably similar to its full self-driving, or FSD system. We're talking about things like navigating highway exits, handling intersections, and even identifying traffic lights during turns. This feels like a strategic move, a way to test the waters and gather data, and perhaps lay the groundwork for a future full FSD rollout. Now, this needs more context. It's direct, full self-driving. The real FSD is facing some serious regulatory hurdles in China, and it all boils down to DAS's, specifically data transfer restrictions. The Chinese government currently prohibits Tesla from transferring driving data collected in China to other countries for training purposes, and the US, on the other hand, isn't keen on Tesla training its AI models within China. It's a classic catch-22, a Guyot tug-of-war that's putting Tesla's FSD ambitions in a tight spot. But you might be wondering, so, when will be the launch? So, what does this all mean for Tesla's FSD prospects in the world's largest EV market? Well, it injects a hefty dose of uncertainty. While some analysts speculate about a potential FSD launch in China this year, I'd advise a more cautious outlook. Given the current guile tensions between the US and China, and especially with Elon Musk's closer ties to the Trump administration, the approval of FSD could become a political bargaining chip, a card that China might not be willing to play quickly. So, while the software update is a positive step, the road to full autonomy in China remains long and winding, fraught with regulatory and political complexities. This leads us to an interesting paradox and a critical juncture for the entire tech sector, and that's in NVIDIA's upcoming earnings report. Now, this isn't just about one company. It's a bellwether for the entire AI investment landscape. The report will tell us a lot about where things are going, and it could cause ripples. So, what are analysts expecting? Let's get down to the numbers. They're predicting revenue of $38.1 billion now. That's a massive 72.4% jump year over year, which on the surface sounds fantastic. But, and here's the catch, it represents a relatively modest 8.5% increase quarter over quarter. We can see the change of the increase rate slowing. It could mean many things, but surely indicate something, right? And that slowdown is what's causing some furrowed brows among investors. There are genuine concerns about whether NVIDIA can maintain its explosive growth trajectory. And those concerns are compounded by whispers of margin pressure due to delays with their next-generation Blackwell platform. Basically, there are concerns of the costs involved with the new platform. It's like a dark cloud and it could impact the overall expectations. However, there is a silver lining. It's not all doom and gloom. To hear some very positive news on the supply chain front. NVIDIA has reportedly secured a whopping 70% of TSMC's advanced chip packaging capacity for 2025. That's a huge deal. It's a sign of strength, a signal that NVIDIA is confident in its future demand and is locking down the resources it needs to meet that demand. And it gives an important clue to how NVIDIA might overcome the slowing increase observed in the quarter-over-quarter numbers. And that's where NVIDIA comes in specifically in the context of the Chinese market. We've talked about the overall positive supply chain news, securing that significant capacity from TSMC. But here is another fascinating and potentially crucial development happening right now in China. NVIDIA's H20 chip, which is a slightly less powerful version designed for the Chinese market to comply with export restrictions, is experiencing booming demand. We're talking about a surge in orders. Major Chinese tech companies, the giants like Tencent, Alibaba, and ByteDance, are reportedly snapping up large quantities of these H20 chips. Now one could ask, why this sudden rush? Why now? Well, there are a couple of key factors driving this. First, here is the undeniable progress in AI development within China. Companies are racing to build and deploy advanced AI models, and they need the hardware to power that. The H20, while not the absolute top of the line, still provides considerable processing power. Secondly, and this is critical, here is a looming threat of further export restrictions. Here is talk that the H20 itself might be added to the restricted list in the future. This is creating a sense of urgency, a get it while you can mentality among Chinese companies. They're essentially hedging their bets, securing their supply before the door potentially slams shut. You might be thinking, but what about the broader implications of this? And I think that is a fair point. This is a complex topic, and from my point of view, the future implications depend on how USA and China relations develop. Let's shift our focus to a company that's been on a wild ride lately, Hims & Hers. This telehealth company, which many of you might recognize for its, shall we say, direct approach to sensitive health issues, has experienced a significant stock price drop recently. It's been a roller coaster, to say the least. Now, on the surface, the company's recent earnings report showed strong revenue growth. It was largely fueled by the booming demand for weight loss drugs. It is a segment of the market that is going through expansion, however, and there is a crucial however here. Digging deeper reveals some concerning trends. We're seeing slower user growth, a declining gross margin, and importantly, increasing competition in the telehealth space. It's a perfect storm of headwinds, raising questions about the company's long-term sustainability. Now, I always try to present a balanced picture. Management, to their credit, has provided optimistic revenue guidance for 2025. They're painting a rosy picture, but the market, at least for now, seems skeptical. The question is, will this be a temporary setback, or is this a sign of deeper challenges for Hims & Hers? The answer is still not clear, and we will continue monitoring. Let's wrap up our stock updates with a quick look at two very different companies, HUD or Home Depot, and UNH, which is UnitedHealth Group. These two are on opposite ends of the spectrum right now. First, the good news, at least for Home Depot shareholders. HUD actually delivered a pretty solid fourth quarter earnings report. They beat expectations, and, perhaps more importantly, we saw an increase in same-store sales. That's a key metric for retailers, and it signals that consumer demand, at least for home improvement projects, is holding up relatively well. It's a positive sign in an otherwise uncertain economic environment. Now, turning to UNH, it's a very different story, and unfortunately, not a positive one. The healthcare giant is facing some serious headwinds. A U.S. senator has launched an investigation into the company's billing practices. This adds another layer of uncertainty on top of earlier concerns about their handling of claims, especially after a recent cyber attack. This is never good news for a company, particularly one in the highly regulated healthcare industry. And, from a technical analysis perspective, things aren't looking much better for UNH. The stock has experienced a significant price drop, and, frankly, the charts are pointing towards a bearish trend. It's broken through some key support levels, and that typically signals further potential downside. So, two very different situations, HUD showing some resilience, while UNH navigates a very challenging landscape. So, to wrap things up, what's the key takeaways from all of this? Well, one thing is clear, market volatility is expected to continue. We've seen a lot of ups and downs, and with factors like inflation, trade tensions, and the future potential stagflation, it is expected to continue. We're navigating a complex landscape with a mix of economic anxieties, geotensions, and company-specific challenges. So buckle up, because the ride is probably going to remain bumpy for a while. But, and this is crucial, don't let the volatility paralyze you. Stay informed, stay engaged, and keep a close eye on those key economic indicators we've discussed, like the PCE data, and of course, company earnings reports. Those will be your guideposts in this turbulent market. Knowledge is power, especially in times of uncertainty. And speaking of staying informed, if you found this video helpful, please give it a like and subscribe to Collin Investing. It helps the channel, and it ensures you won't miss our future deep dives into the market. I sincerely appreciate your support. Finally, if you know someone else who's interested in finance and investment, share this video with them. Let's spread the knowledge and help each other navigate these challenging times. Thank you for your time, and I'll see you in the next video.